Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about market volatility. Obviously very timely given the current volatility in capital markets and economic uncertainty. But the principles I'll talk about today really transcend this current environment. And they're important principles that we need to be mindful of when we're trying to deal with or cope with short-term market volatility. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement planning and overall wealth planning. So when you look at market volatility, there's a few principles to keep in mind. So the first principle is you really should get prepared for market volatility before it happens. And that really comes through a process of taking a look at your own investment temperament, how much risk that you feel comfortable taking on, and doing a really clear-minded assessment about what kind of investor you are. So all portfolios have a certain volatility equation attached to them. Obviously, at a very basic level, the higher the long-term performance, the higher the market volatility in the short term. So you need to assess that. Part of that assessment also is looking at your forecasting and your planning, and either on your own or working with an advisor, assess what kind of returns you need to aspire to achieve your goals. So number one, what's your investment personality? Number two, have you done a plan? Have you kept your plan updated to confirm what returns you need to achieve? Not what the market's achieving. You don't want to ignore that, but what do you need? It's basically called goals-based investment planning. The second principle you need to keep in mind is that it is virtually impossible to time the markets, and that specifically relates to stock market investing. So when you look at your portfolio, if you need to get returns above the risk-free rate, let's say for the discussion today, the risk-free return is 2%. Let's say you need to get 4 or 5% total return, so another 2 or 3% above the riskless asset class like GICs, T-bills, or high-yield savings accounts. Then by definition, you're going to need probably some alternative assets like stocks in your portfolio to drive higher returns. With that comes more volatility in your portfolio. So once you decide that you need to have growth assets or stocks in your portfolio to achieve your long-term objectives financially and from a return standpoint, then you are essentially committed. You don't want to buy into the idea that you can time stock market returns. We've had previous videos that talk about that. I'll have a link in the show notes for this particular video. Once you are in the markets, it's not productive to try to time going in or out if there's short-term market volatility, although every fiber of your being, particularly if you're a more cautious, skittish investor, will push you in the direction of just moving out of the markets. The next principle is embrace the idea of timeline investing, or sometimes referred to as 3-bucket strategy for retirement income planning or investing. And essentially you should have 3 timelines in mind for your portfolio. Timeline number 1 would be assets that might be needed from your portfolio over the next 1, 2, or 3 years for income or liquidity needs. You want to be very cautious with that part of the portfolio, so you're going to be in guaranteed risk-free investments. Part of the planning that you do to decide how much needs to be in this area is through a financial plan or a retirement strategy plan, either that you do on your own or with your advisor, to confirm how much do you need in this category. You need to do some advanced homework, you need to look at the future, come up with the numbers that you may require from your portfolio. You want to have sufficient risk-free assets in your portfolio to deal with those needs, but not more than what you need, because those assets will end up being a drag on the overall long-term performance of your portfolio. So you want to make sure you have safe harbor, very conservative to the extent you need it, but don't have too much. The next category in the timeline investing would be your midterm investments. These are assets that you may need in the next 4, 5, 6 years. You have a little more time ahead of you. You have a little bit of time to ride some short-term volatility. But again, those investments need to be relatively cautious. They don't have to be guaranteed investments, but they need to be a little more conservative. And then the third category would be your long-term assets. So it's money that you don't really need for another 7 or 8 plus years. You want to be in growth assets, equity investments. Time is the investor's best friend. So you'll have a probability of getting above average returns on that part of your portfolio that will lift the overall returns that you'll experience on your accounts. So the next area is make sure you focus on using high quality investments for your portfolio. So examples would be blue chip stocks, companies with strong balance sheets that pay consistent dividends, companies that have pricing power so that when inflationary pressures go up, they can pass those increased costs that they have onto their consumers so they can stay profitable and financially healthy. You can buy individual stocks, you can buy ETFs or mutual funds that have high quality investments. So during times of market volatility, you tend to find capital goes the quickest to high quality investments. So make sure you have that quality in your portfolio. So the next principle that you want to keep in mind is sometimes it does make sense to have what we call explorer components to your portfolio. So for some of you, what I've been talking about sounds kind of ho-hum and boring. Now, it doesn't feel like it's boring when you go through market volatility. But there can be an aspect to your portfolio for some of you as investors that we refer to as Explorer, where you have your core portfolio. It's the gotta be there, consistent performing portfolio over time. But there may be components of your portfolio that you might use to explore or take advantage of certain opportunities. So it could be periods when, let's say, certain sectors, like energy sector, goes down, and you think that might be a good place to invest money when it's reduced its value. It could be precious metals. It could be commodities. It could be various aspects of the economy that present an opportunity because they've been beaten up. Technology would be another example of that. Now, in saying all that, most investors are better off focusing on their core portfolio, taking on sufficient market risk to achieve their long-term goals and objectives, but not taking on too much risk. And then one of the mantras we use in our practice is, don't take on more financial risk than you need to achieve your goals, because temperamentally, people can make some bad decisions if the emotion goes up around their portfolios and how they're experiencing them. Now, another point to keep in mind is just be clear on the expectations you should have in your portfolio. So I'll give you an example. On a balanced portfolio, roughly speaking, would be 40% bonds, 60% stocks. For almost every 10-year period you look at, historically anyway, you can count on the fact that there'll be roughly 7 to 8 positive years over that 10-year period and 2 to 3 negative years. That's basically a truism. Now, how do you respond to the negative years? You want to make sure that you have built into your portfolio a mechanism to rebalance periodically. So particularly for retired clients, in those good years, you want to make sure you're harvesting some of those profits because some of that money might be needed for income payments or liquidity needs. That's not quite as critical for someone that's not retired, but as you get closer to retirement, you want to be conscious of that. Number two, when you have negative years, you want to make sure that you're doing some rebalancing. So some securities we recommend for portfolios actually do systematic rebalancing. Internally, it's just automatic. You want to make sure that you're taking the opportunity within your portfolio that when there's a market correction, so a technical correction of roughly 10% or a bear market of 20-25%, that you're adding back to equities during those times. Rarely are clients not well rewarded over the next 5-6 years from the discipline of adding back when the market's down. So normally that's a high probability decision. You want to make sure you buy when the market's into a correction territory and take profits along the way, particularly if you are retired. Those are really, really important things to be mindful of. And then the last tip really is an important one. It may sound a little bit self-serving. We've talked about this before in past videos, is you want to make sure you have a way of dealing with the stress or anxiety that can come up with investing. And it's going to come up from time to time. Even though the market's up more than it's down, the reality is during times of uncertainty and volatility, it can be quite stressful. So what you find is with families that have advisors, so advised households tend to have better performance overall in their net worth or balance sheets than people who are non-advised. And one of the reasons for that is advised households tend to act with more financial discipline. And that discipline, which is often just the coaching relationship they have with their advisor to help get proper context for market volatility, helps them to make those high probability decisions. Well, it's my hope that you found this video helpful, a few tips to be mindful of. Unfortunately, many of these tips should be taking place before you hit market volatility. It's very difficult to make corrections when we're in the midst of it. But as we see recovery in the markets, you want to use that as an opportunity to do a reset in your portfolio and keep some of these tips or strategies in mind. Now, if you're beginning to think about your portfolio or your retirement plan, make sure you reach out to us. There's a link to our webpage where you can start a conversation. We'd be delighted to do that. And if you want more information about our services, just go to our website. As well, if you haven't subscribed yet to our channel, make sure you do that right now. And I'm wishing you all the best in your retirement and overall wealth planning.